Two versions of you wake up to the exact same sound, a smoke alarm. The first version runs outside, watches the house burn, and thinks, "Thank God I have insurance." The wealthy version does the same thing. But a few hours later, the first you is searching through old emails, trying to prove the television wasn't found beside a dumpster. The wealthy you already has emergency money, temporary housing, and specialists trying to save the artwork. Same fire, same person, completely different version of insurance. Because as your wealth grows, insurance doesn't simply cover more expensive stuff. It changes what gets protected, who answers the phone, and how much control you have when everything goes wrong. At the bottom, you're buying permission to drive. At the top, you might own the insurance company. Here's how insurance treats you at every level of wealth. Level 1, the legal minimum. You have no savings, an aging car, and exactly enough insurance to keep a police officer from making your morning significantly worse. Then, one rainy afternoon, you look down at your phone for 2 seconds. Unfortunately, the car in front of you uses those same 2 seconds to stop. You hit it. Then it hits another car. Congratulations, you have invented a 3-car problem. Your liability insurance may cover the other driver's injuries and damaged property, but only up to your policy limits. Once those limits are exhausted, the remaining damage doesn't politely disappear. Depending on the circumstances and local law, the other people may pursue you for it. And your own car? If you didn't buy collision coverage, your insurer may look at the smoking remains and offer something extremely valuable. Emotional support. You technically had insurance. You were legal. But legal to drive and financially protected are two very different products. At this level, insurance protects you from the first part of the disaster. The rest of it knows your home address. So when you finally save some money, you upgrade. Unfortunately, insurance has another surprise waiting for you. Level 2, the deductible life. You now have $10,000 saved and a slightly better car. One morning, you walk outside and discover an empty parking space. For 3 beautiful seconds, you wonder whether you parked somewhere else. You did not. Your car has begun a new life without you. This time, you bought comprehensive coverage. Theft may be covered, so you call the insurer expecting a victory. Then you meet the deductible. A deductible is the amount you're responsible for before the applicable insurance payment, and the insurer values the loss according to the contract, not according to the emotional bond you developed with the cup holder. Your car might have cost $25,000 several years ago. That doesn't mean it is still worth $25,000 today. The payout can be reduced by the deductible, while the car's current value may be far below the cost of buying another one you actually want. The thief took the car. Depreciation took some of its value. The deductible took another piece. It was a collaborative project. This is when you learn the first insurance secret. The monthly premium is not the whole price. The deductible, exclusions, limits, and valuation method decide what the policy is really worth when you need it. Eventually, you stop buying insurance based only on the cheapest number on the screen. You begin protecting the life you're building. Level 3, replacement life. Now you have around $100,000 in savings and investments. You own a home, you have a family, and you have an income everyone quietly depends on. Then a pan of oil catches fire in the kitchen. You try to fight it with water, which is an excellent technique if your goal is to introduce the fire to the ceiling. The family escapes, but the kitchen and much of the house are damaged. This time, your policy is designed around replacement cost for covered property, subject to its limits and terms. That distinction matters. Actual cash value can subtract depreciation. It may treat your 5-year-old couch like a tired rectangle that survived 3 moves and several mysterious stains. Replacement cost coverage may pay to replace covered property with something of similar kind and quality without subtracting depreciation. You also documented important belongings instead of expecting your memory to perform forensic accounting after a fire, and your protection no longer stops at the house. Life insurance can protect your family if you die. Disability insurance can help protect your income if you become unable to work. Insurance is finally defending more than an object. It is defending the future that object belongs to. But as you build real wealth, damaged property stops being the only threat. Because now, if someone sues you, there is finally something worth aiming at. Level 4, the liability shield. Your net worth reaches roughly $1 million. You have a home, investments, retirement savings, and a teenager who recently acquired a driver's license. This is less of a milestone and more of a controlled experiment. One evening, your teenager causes a serious accident. The medical expenses and legal claim climb beyond the liability limit on your auto policy. This is where an umbrella or excess liability policy may become important. Subject to its terms, it can provide additional liability protection above qualifying home or auto limits and may help fund the legal defense. Think of your normal policies as walls around your money. The umbrella is the roof you suddenly remember you need when lawyers begin falling from the sky. But wealthy households generally don't buy one giant umbrella while keeping tiny policies beneath it. Umbrella insurers commonly require certain underlying liability limits first. That is the second wealthy insurance secret. Protection is built in layers. One policy handles the first section of a covered loss. Another may respond when the damage climbs higher. This doesn't make your assets invincible. Policies still have exclusions, conditions, and limits. But the strategy changes. At lower levels, you insure the car. At this level, you protect everything the car accident might reach. Then your wealth grows again, and insurance stops waiting for disasters to happen. Level 5, the private client. At $10 million, your house is no longer just a house. It is a custom home containing artwork, jewelry, wine, collector cars, and at least one chair nobody is allowed to sit on. A fire in this home creates a completely different problem. An ordinary policy might provide limited coverage for certain valuables. Wealthy clients may instead schedule important items separately, maintain professional appraisals, and purchase specialized coverage designed for those possessions. Depending on the insurer and policy, private client service may include risk assessments before a loss, extended replacement cost protection, comparable temporary housing, advance payments, specialist restoration, or a cash settlement option after a covered total loss. The insurer might send experts to determine whether a damaged painting can be restored, instead of asking you to upload a photograph under the category Other Household Item. That is the third wealthy insurance secret. The claim is prepared before the disaster. The valuables were documented. The property was assessed. The coverage was designed around the actual lifestyle. Wealth doesn't make the contract disappear, and it doesn't guarantee every claim gets paid. It buys access to contracts, limits, and services designed for complicated losses. At the bottom, you spend hours proving what you owned. At this level, someone may already have an inventory. But the final level goes much further. Instead of purchasing a more powerful policy, you can change who owns the risk. Level 6, own the risk. You now control a business worth more than $100 million. It has buildings, vehicles, employees, unusual risks, and insurance premiums large enough to develop their own gravitational field. Some risks are expensive to insure commercially. Others are specific to your business or happen frequently enough that transferring every dollar may not make sense. So the company may create a captive insurer. A captive is a regulated insurance company owned by the business or group whose risks it insures. The business pays premiums to the captive. The captive sets aside capital, maintains reserves, pays valid covered claims, follows insurance rules, and may purchase reinsurance for losses too large to retain alone. This is not opening an offshore company on Tuesday and buying a yacht on Wednesday. A legitimate captive requires real insurance operations, proper capitalization, regulation, reporting, and a genuine business purpose. Arrangements marketed mainly as easy tax tricks can receive very unfriendly attention from regulators. But when a captive is legitimate, the power shift is enormous. At level 1, you ask an insurance company to protect you. At level 6, your business may own the company holding part of the risk, and that is what wealth really changes. First, insurance gives you permission. Then it helps you recover. Then it protects your income, your assets, and your lifestyle. Eventually, it helps you design the rules around the risks you can afford to keep. The fire is still hot. The crash still hurts. The lawsuit is still real. Money does not remove the disaster. It determines whether the disaster controls you or whether you were prepared to control what happened next.